And then I am happy to invite the next speaker, Ronald Peter Stöferle from Austria on behalf of Incrementum, who will talk about the monetary tipping point.
Good morning, ladies and gentlemen. It feels a bit strange talking about inflation as an Austrian economist here at the Austrian National Bank, but I feel really well in the middle of so many fellow Austrian friends, economists, and next to the Austrian gold reserves of more than 280 tons. Today I will make the case that we are at a monetary tipping point, a tipping point of inflation. And I think that Jeff Booth is here, right? Just to avoid any questions from you, I know that the natural state of our economy would be highly deflationary, so I got that. But I will discuss how we reach this tipping point, why inflation is not transitory, and what investors can do to protect themselves in this new regime. But before I start, I want to sincerely thank Federico and the whole team for putting together such a fantastic conference in these challenging times. I really appreciate it, and I love the fact that Austrian economics is finally coming back home again. Few words about me. I'm a practitioner. We run an asset management company based in Liechtenstein. We have 5 equity partners. The investment philosophy of our company is rooted on the principles of the Austrian School of Economics. We publish the annual In Gold We Trust report. You might have heard about it. It's published in German, in English, and in Mandarin. We reached more than 2 million people with the last edition. And I also published this book, Austrian School for Investors, a couple of years ago, together with my dear friends Mark Walek and Rahim Tagizadega. Now let's talk about tipping points. Oxford Language defines a tipping point as the point at which a series of small changes or incidents become significant enough to cause a larger, more significant change. The sociologist Malcolm Gladwell helped to bring the term tipping point into popular usage in the year 2000 when he published a book of the same name, a book that I highly recommend. The tipping point is that magic moment when an idea, a trend, or a social behavior crosses a threshold, tips, and then it spreads like a wildfire. Just as a single sick person or a bat can start an epidemic of the flu, so too can a small but precisely targeted push cause a new fashion trend. But tipping points are by no means confined to sociology. They can be observed in diverse areas ranging from physics to finance and history. The video behind me, if it works, yes, gives us a simple but dramatic example from physics of a tipping point, leading to a precarious situation descending into chaos. You'll be pleased to know that the driver of the truck was unharmed, but his boss may have been quite unhappy. What is crucial to understand, ladies and gentlemen, the tipping point demonstrated in this video was only made possible by the inherent instability in the warehouse layout. We can also see examples of tipping points, of course, in the realm of finance. Bank runs are a classic example. They result from a sudden loss of confidence and trust, typically after risks have built over a much longer period of time. You'll all likely be familiar with the collapse of Lehman Brothers, or perhaps the collapse of the British high street bank Northern Rock in September 2007. Northern Rock got bailed out for 37 billion British pounds, which is peanuts in today's money. But these banks both trace their roots back to the 1850s. So they were around for more than 150 years when they collapsed. But just a few days, a few moments were enough to send these banks into insolvency. And maybe the best tipping point example comes from 20th century history. The tipping point was an event that triggered momentous global changes, larger than anyone involved could have imagined, the start of the First World War. The story is closely tied to my own country, Austria, the assassination of Austrian Archduke Franz Ferdinand. It catalyzed a chain of events that went on to profoundly reshape Europe and the entire modern world. What is important to understand, ladies and gentlemen, it was not the assassination alone that caused the war, but the precarious buildup of arms, rivalries and tensions that came before and already developed for years, if not decades. The historian Christopher Clark wrote an excellent book about the build-up to the World War. He called it The Sleepwalkers, because he saw that Europe had long been sleepwalking into a catastrophe. But it took the tipping point of Franz Ferdinand's assassination to reveal the extent of those tensions. The assassination was the straw that broke the camel's back, a tipping point in the true sense. So I recount this lesson from history because I see it as relevant to the situation we find ourselves in today. I believe that we have been sleepwalking to a new tipping point. This tipping point that I will describe now will trigger changes that will be primarily economic and monetary rather than hopefully military in nature. Now, what do I mean by this? Since the 1980s, a period referred to as the Great Moderation, Western economies have become accustomed to low inflation. Low inflation has persisted for so long that the idea of it rising on a long-term basis seems completely implausible to most economists, politicians, central bankers, and investors. Yet I want to share with you that from my point of view, the COVID-19 pandemic was the tipping point that will change this long-standing dynamic. We are now moving from an era of pure monetary inflation to asset price inflation and finally to price inflation. Now, the first long-term trend that has built up over the last couple of years is obviously money supply growth. We can see from the graph behind me that broad money, M2, the measure of money supply most relevant to inflation probably, has been accelerating since the year 2000. This trend was exacerbated following the global financial crisis, and one of the actions taken by central banks in response to the GFC was to flood commercial banks with liquidity in the form of base money. M2 continued to grow solidly as a result, but it is only recently that its growth has started to accelerate again. In 2020, M2 money supply increased at the fastest rate on record, with the total supply of US dollars in circulation growing by 25%. It has far surpassed levels that we have last seen in the highly stagflationary 1970s. So given that money supply growth was so big, so enormous, why haven't we seen more dramatic inflation yet? First of all, because inflation is a process. Secondly, there are always time lags involved. And thirdly, due to the lockdowns, we experienced a sharp fall in the velocity of money, or as the Austrians would call it, the demand to hold money. It is worth looking back briefly at history to understand what happens when velocity falls. In both 1933 and 1946, the velocity of money was similarly low, as we can see on this chart. In both cases, the US government resorted to radical measures to increase velocity again. In 1934, as you all know, the US devalued the dollar against gold by almost 70%. And in the period 1946 to 1951, it enforced financial repression in cooperation with the Federal Reserve. They basically implemented yield curve control, something that I see coming rather soon. Currently, the velocity of money is at even lower levels than it was in 1933 or 1946. As such, we should not be surprised by similarly extreme countermeasures of financial repression being implemented again. I now want to highlight another very important trend, the rise of government credit guarantees. Governments are going direct, and they are now circumventing central bank money creation. Earlier this year, I interviewed my great friend, financial historian Russell Napier, about his views on inflation and repression. Russell has been a deflationist for decades, but now he also predicts sustained inflation. He said the crucial structural change here is that governments are providing credit guarantees to the commercial banking system. And now we have, across the world, bank credit growing really strongly in a recession, which is absolutely unheard of. He gave the example of the UK Chancellor introducing government guarantees on mortgages up to £600,000 announced in the March 2021 budget. Why is it important? Because unlike QE or a reduction in interest rates, these schemes offer direct incentives for banks to increase lending and thereby expand the broad money supply. Since the government guarantees these loans, the risks associated with default are passed on to society at large. Those government guarantees are a fundamental change in the way money is created. So we have seen that the great moderation might be over, that money supply growth has been accelerating. And we see higher inflation numbers, although we are always being told that it is only transitory. And these trends alone are enough to raise concerns about persistent inflation, but I now want to turn some additional factors in policy decisions and trends in the real economy that I regard as further inflationary drivers. Fiscal regimes seem to increasingly resemble what our friends at Nordea Capital Markets called OeNomics. The main tenets include a policy that I would describe by going direct. Everyone gets a bailout, helicopter money and MMT-style policies, credit guarantees by the government and universal basic income. These kind of radical ideas were previously only advocated by very left-wing voices. Since the COVID crisis, they have entered the mainstream. And as you know, politicians always calibrate their measures and their responses based on the lessons during their most recent crisis. So I'm absolutely sure that in the next downturn, and we already see that economic numbers are weakening significantly, those direct measures will be used again. The rise of OeNomics is part of a more fundamental shift that I see happening. This is a shift from monetary to fiscal dominance. One of the reasons for this is that the toolbox of stimulatory policies available to central banks is largely exhausted. Sometimes it seems that Fed policy is the only thing that counts for markets anymore. But what if central banks are becoming increasingly irrelevant? What if the days of monetary policy being the driving force are over? Andy Haldane, the outgoing chief economist of the Bank of England, wrote that for years after World War II, the Bank of England was effectively a think tank and that the government did set interest rates. We could go back to that. So central bank independence might not formally be cancelled, but the power of central banks seems to be slipping away. And as their power is slipping away, we now see new tasks for monetary policy. Safeguarding price stability has always been considered a central objective of an independent central bank. Obviously, it is the central mandate of the ECB, but increasingly one gets the impression that central bankers are speaking out more often on issues such as sustainability, climate change, or diversity than on monetary policy matters. They often sound like Greenpeace activists or social workers. Christine Lagarde, for example, against all custom, made a public statement of support for the Green Party's top candidate in the German general election. Now, ladies and gentlemen, I gave you some additional reasons for inflation from my point of view going structurally higher. And there are many, many more. We all know about these supply chain disruptions. We all know about demographic drivers. We know about deglobalization that is currently happening. But I think it is important to give you just a brief overview what actually works in inflation. Don Cox said, "Those who know it best love it least because they have been hurt the most." Now, it is well known that commodities and gold tend to perform well during periods of rising inflation. The table behind me demonstrates this. We crunched the numbers and found out that actually commodities and gold have got the highest inflation beta. Now, you might ask yourself, why didn't gold perform so well this year? Well, we shouldn't forget that gold was up 25% last year already. So from our point of view, gold is always very, very early on in discounting future inflation and future monetary policy. Long-term commodity trends indicate that this price surge that we have seen over the last couple of months is only at the beginning. The graph behind me demonstrates where we are today, showing that measured with a 10-year compound annual growth rate, commodities are still heavily undervalued. Commodities have been in a brutal bear market for more than 10 years. This resulted in a significant lack of investment activity and declining production volumes. The increasing focus on fiscal stimulus, infrastructure projects and so on will stimulate the commodity sector much more than it was the case in a pure quantitative easing paradigm. Institutional investors are still heavily underweight in commodities. And from our point of view, this is a super cycle that has started, but where nobody is really invested in. As I told you, gold worked pretty well last year, up 25% in euro terms, up 14% in 25% in dollar terms, 14% in euro terms. In euro terms, year to date, it's actually not that bad. It's down 0.9%. But what I like to show you with this chart is that simply, gold actually did its role pretty well, and that there's not the perfect inflation hedge. So I've got only 2 more minutes. But what is interesting from my point of view, that we're seeing increasing interest coming from central banks, but we also now have significant moves from institutions. The major data analytics software maker Palantir, probably one of the best connected companies out there, with mostly clients from government agencies and the defense industry and intelligence. They bought $50 million worth of gold, and they said they want to hedge against black swan events. Pretty interesting from my point of view. And now I'm already coming to my conclusion. From my point of view, ladies and gentlemen, higher inflation rates are not transitory. The pendulum between deflation and inflation is swinging in the direction of inflation. We are moving from an era of monetary dominance to a new era of fiscal dominance. Real interest will remain negative for years to come. For investors, this is a very, very challenging environment. We see the gold price significantly higher, $4,800 by the end of this decade, and we think that new all-time highs will be achieved next year. And by the way, we are very, very open to cryptocurrencies and Bitcoin. We don't see basically as a religion. We regard Bitcoin as a hard currency, as something that actually fits from a portfolio perspective. If you can deal with the volatility, it fits perfectly into your portfolio, and therefore in 2 of our funds we actually combine physical gold, mining stocks and cryptocurrencies. So I hope that you enjoyed this. I did so very much, and I thank you very much for your attention. Is there some time left for questions?
No.
No, okay, but I'll be around. Thank you very much.